Let's talk about Employee Stock Purchase Plan, or ESPP for short. We will discuss how to evaluate your company's ESPP to decide if it makes sense for you and how to avoid surprises at tax time. You might be wondering, how does an ESPP work? An ESPP lets you purchase company stock at a discount. This will usually be somewhere between 5 to 15% off. For example, if your company stock was $100 and you got a 15% discount, you would buy the stock at $85. This would give you a profit of $15 if you were able to sell right away. If you hold on to the stock, the price could fluctuate and the profit could shrink or grow. To participate, you can enroll and choose a percentage of your pay to contribute during the offering period. Most companies will have a limit on the percentage you can contribute. There is also a total limit set by the IRS of $25,000, but the company limits will most likely keep you under this amount. Your contributions will automatically be deducted from your payroll check and placed in a company account over the offering period. Let's say in this case the offering period was 6 months. At the end of the 6-month offering period, all the money that had accumulated in that account will automatically buy stocks for you at the discounted rate. Each company will have its own set of rules on how the ESPP works. Here are some common things to look at when deciding if you want to participate. You want to find out if you are allowed to sell your stocks as soon as they are purchased. If this is the case, you're almost guaranteed to make a profit because you will buy the shares at a discount and you can sell them before the price has time to fluctuate. If there isn't a waiting period, then I don't really see any reason not to participate unless you can't live without that money during the offering period. If there is a waiting period before you can sell, then it becomes more risky since you don't know for sure if the market will go up or down. If this is the case, you'll want to do a little more research on your company stock and see if that is a risk that you want to take. Another thing to look for is called the look back feature. This will generally look at the stock price at the first and last day of the offering period, and then whichever price is lower, you will buy stock at that lower price and receive your discount on top of that. Let's say your company stock is $100 on day 1 of the offering period, then on the last day of the offering period, the stock is $110. If your company was offering a 15% discount, you will be buying stock at 15% off the $100, which would be $85, and it would immediately be worth $110, which is a gain of $25 per stock. Look back periods have a potential for some truly great gains on your ESPP if your company stock performs well during the offer period. How are the taxes handled? Taxes can get a little confusing, but let's take a look. The shares you purchase through an ESPP will either be qualified or disqualified depending on when you sell your holdings. A qualified disposition occurs when the shares are held for the required holding period, which means they'll be taxed at the more preferred capital gains rate. And if they are disqualified, they will be taxed at your normal ordinary income rate. Before you sell, you should take this into account. There are 2 conditions that must be met to have a qualified disposition when you sell. Number 1, the sale must be more than 1 year from your purchase date. And number 2, the sale must be more than 2 years from the date that the offer period begins. Here is an example from a company that has a 6-month offer period. Let's say the first day of the offer period was January 1st, 2025. That would make July 1st, 2025 be the purchase date. You can then choose to sell these shares anytime now if your plan allows this. If you sold now, they would be disqualified because we do not meet the 2 conditions. You can see in this chart when you would have a qualified or disqualified stock. You can see there's a section in this chart where you're more than 1 year from your purchase date but still less than 2 years from the beginning of the offer period. In this specific example, you would need to hold on to your stock for 1.5 years to be able to meet that qualified position. To meet the second condition of being over 2 years from the start of the offer period, you would need to sell your stock on or after January 1st, 2027. At this point, your stock would be qualified and you'd get the preferred capital gains treatment. Let's look at an example that compares how the taxes could work. We will use the same numbers for both the qualified and disqualified sales so you see exactly how the taxes would be affected. For example number 1, we'll use the fair market value of $100 on enrollment. Then, let's say the fair market value on the purchase date is $110. Our discount is 15% off the lowest of these 2 fair market values. This makes our purchase price $85. Now, to make this example easy, let's say we purchased 100 shares at that price. When you go to sell the shares, you could have long-term or short-term gains. Gains refers to the increase in value of your stock. You are only paying taxes on the increase of value. The short-term gains would be applied to anything held for less than 1 year, and long-term would be applied to anything held over a year. Short-term gains are taxed at your ordinary income rate. Here's the 2025 tax bracket for ordinary income. Long-term gains are taxed at a lower rate. Here is the table for a long-term capital gains rate for 2025. In this example, we will be selling everything after a year, so we will be dealing with just long-term capital gains. And we are also going to say that we make $60,000 a year, which puts our capital gains rate at 15% and our income tax bracket at 22%, assuming that we are single. Let's say we go to sell those shares we purchased and they're now worth $125. If this was a qualified disposition, we would pay some long-term capital gains. In this scenario, we take the $125 fair market value on date of sale minus $100 fair market value on date of enrollment, and you get $25. You then take that $25, multiply it by 100, you get $2,500. Then multiply that by 15%, you would pay $375 in long-term capital gains. Next, we take the $100 fair market value on enrollment date minus the $85 purchase price, and you get $15. Multiplied by 100, that's $1,500. You then multiply that by 22%, and you're going to pay $330 in taxes for the normal income portion. The total taxes paid in this example is going to be $705. Let's say you sold the same shares, but you sold them one day before they became qualified, so now they were disqualified shares. Let's say the price happened to be the same, $125 on the date you sold. Take that $125 fair market value on the sale date minus $110 on the fair market value on the date of purchase. You get $15. Multiply by 100, you get $1,500. You then multiply this by 15%, you get $225 in taxes for the long-term portion. Then for the normal tax rate, we would take the $110 fair market value on purchase date minus the $85 purchase price. You get $25. Multiply by 100, you get $2,500. You then multiply this by 22%, and you get $550 in taxes for this portion. That brings your total up to $775. In both cases, you're paying taxes on $4,000, but with the qualified disposition, you're paying the lower capital gains rate for a bigger portion of the sale. In this case, you pay $70 less in taxes. Remember, paying taxes on your capital gains is not a bad thing. This means you made money. There is also some level of risk involved if you're holding the stock to reach the qualified requirements. The stock could drop in price and all your gains could be gone, and then you wouldn't be paying any taxes because you didn't make any money. But if you're deciding between two different lots to sell and one is qualified and one is disqualified, it might be more tax advantaged to sell the portion of your stocks that are qualified. When tax season comes around, if you sold some of your ESPP, you will want to take a close look at your 1099 from your brokerage account, as well as any supplemental information which can be included with your 1099 or might be a separate form. Your cost basis may be different on these two forms due to the fact you received a discount on your stocks, and that discount is taxed as ordinary income and was already reported on your W-2. If you don't take a look at the supplemental information, you may end up using the wrong cost basis and paying extra taxes. Look, I'm not a tax professional and tax laws can change, so make sure to contact a tax professional if you have any questions about your specific situation. So, should you invest in your ESPP? If there are no restrictions on when you can sell after the purchase date, I believe it is a no-brainer and can be a great way to get some free money since you can sell immediately for a profit. If there are restrictions on when you can sell, then you'll have to decide if holding your company stock for the required amount of time is worth the risk. If you do participate in your company's ESPP, just make sure you stay diversified and don't let your company stock become a large portion of your portfolio. I would recommend not having more than 5 to 10% of your portfolio in any single stock. The last thing you want to have happen is to have the majority of your wealth in a company that you work for, because if the company struggles, your job and investment could both take a hit. If you have any other questions, let me know in the comments. Otherwise, that is all for today. If you found this helpful, give me a thumbs up and subscribe, and I will see you next time.